When the market feels uncertain, one of the smartest things you can track is where big investors are putting money, and that's exactly what this video is. You asked for a monthly breakdown, so here we are with the March edition. We're breaking down 10 stocks, 5 stocks that FIIs are buying and 5 that DIIs are buying. We've also made sure to include stocks from large, mid and small cap universe, so stay tuned till the end. Hi, I'm Aparna, and in today's video, we are going to break down these 10 stocks, look at the business behind these, the numbers, the risk, and understand why FIIs and DIIs might have picked these. So let's get right into it with the top 5 stocks that FIIs picked. Let's start with FII stock number 5, that is UPL. Now, at the most basic level, UPL is an agrochemical company. They make crop protection products like pesticides, fungicides, herbicides, and they sell across 140 plus countries. So, if farming is happening somewhere in the world, UPL probably has a product involved somewhere in that supply chain. Market cap is around 50,000 to 55,000 crore, which makes it one of the very few Indian companies operating at genuine global scale in this industry. Now, the stock has had a rough couple of years. Debt built up, the business got complicated, and investors largely lost interest. But here's what actually changed. UPL has been aggressively cleaning up, and that's visible in the numbers. The net debt to EBITDA ratio, which is basically a way to measure how heavy the debt burden is relative to earnings, has already come down from 4.6x to nearly 2x. That's a massive improvement in a short period of time. At the same time, EBITDA has crossed 9,000 crore and margins are approaching 18%. Now look at what FIIs actually did. They increased their stake by about 6.4% in just one quarter. That's not passive, that's a deliberate bet. What they might be seeing is a good business that got weighed down by debt, and as that debt comes down, the market is going to start valuing it very differently. But yes, there are risks. Execution is key. If it slows down, the stock may not move much. And since this is a cyclical business, things like crop prices, inventory, and execution over the next 12 to 15 months will decide how it performs. Okay, now let's move on to FII stock number 4, which is Home First Finance Company India Limited. I find this one genuinely interesting, and here's why. Home First is a housing finance company, but it's targeting a very specific type of borrower. The first-time home buyer with informal income. Think of the person who runs a small shop or has a part-time job or earns in cash. But they're usually turned down by a traditional bank because the paperwork doesn't fit the standard template. And Home First's entire edge is that they have built a smarter way to assess these borrowers. They use data science and alternative data, things like utility payment history, spending patterns, to figure out who among these informal borrowers is actually a reliable credit risk. And because they have cracked that underwriting model, they can serve a huge part of India that large banks completely ignore. The numbers are genuinely strong. With a market cap of roughly 11,000 crore, their loan book has crossed 14,925 crore and is growing at 25% year on year. Profits are up 44% year on year. Return on assets is around 4%, which is a healthy number for any lender. FIIs added about 4.9% to their stake in just this quarter. And what they could be seeing? This is a niche lender with a real moat operating in a massive undeserved market with strong spreads and very healthy returns. The thing to watch though is asset quality. This segment can be sensitive to economic cycles. If things slow down and these borrowers start struggling, the NPA numbers can move quickly. So keep an eye on that. Now let's move on to FII stock number 3, Vishal Mega Mart Limited. A value retailer built for middle India. Affordable fashion, daily essentials, household stuff, all under one roof. Market cap is around 53,500 crore. And what's interesting is that while most retail companies are finding it hard to grow right now, Vishal is genuinely taking market share. Revenue grew 17% last quarter, profit grew 19%, but the number I actually care about more is the same store sales growth of 9.6%. And here's the important detail. About 70% of that growth came from more footfalls, not from charging existing customers more. That's the difference between real demand and inflation-led revenue. Vishal is actually getting more people through the door. Their own private label brands are now making up 74.5% of total sales, and that matters because your own brands carry significantly better margins than reselling someone else's products. The store network has expanded to 771 locations and they are moving fast into South India. Let's look at the FII activity. It jumped from 15.52% in December 25 to 22% by March 2026. For a newly listed retailer, that kind of institutional interest building up so quickly is a meaningful signal. Now, here's what you should watch going forward. Can same-store sales growth stay around 10% as new stores mature and competition intensifies? Because if it can, this business can look very different 3 years from now. Okay, with that, let's move on to FII stock number 2, Shriram Finance. At 2.36 lakh crore market cap, this is one of India's largest NBFCs. And the core of what they do is finance the people that big banks don't really bother with. Small truck owners, rural borrowers, and small businesses. In fact, roughly 1 in every 4 used commercial vehicle loans in India goes through Shriram. That's a dominant position in a niche that requires real underwriting skills. Now, here's the really interesting part of this story. For most of 2025, FIIs were actually selling Shriram. Ownership dropped from 53.6% all the way to 47.2% by December. And then, suddenly, in early 2026, it shot back up to 56.1% in one quarter. So, what changed? MUFG, which is a major Japanese bank, is in process of investing into Shriram. And management has said that this deal could reduce their borrowing costs by 100 basis points over the next 2 years and push loan book growth from around 16-17% to nearly 20%. For an NBFC, this is a really big deal. Lower borrowing costs mean better margin, better returns on capital, and the ability to grow faster without taking on extra risk. It basically creates a compounding effect across the entire business. Now, FIIs are essentially looking past the short-term dilution from this deal and buying the future version of Shriram, one that's better funded, grows faster, and earns more per rupee deployed. The key things to watch are whether the MUFG deal gets regulatory approval and whether borrowing costs actually start to fall. Now with that, let's move on to the most bought company by the FIIs this quarter. FII stock number 1, Sammaan Capital. You might not have heard of this one, and that actually makes the FIIs move even more interesting. Sammaan Capital is a housing finance NBFC with a market cap of around 17,845 crore. And when you look at what FIIs did, ownership went from 24.9% in December 2025 to 46.2% by March 26. That's basically almost doubling their stake in a single quarter. That's a very loud signal. So what are they seeing? The answer is a business model transformation. Sammaan Capital is moving from traditional housing lender into a broader asset-light financial platform. This is actually a smarter way to scale a housing finance business. You carry less risk on your books, you recycle capital faster, and the company has said this shift could reduce operating costs by 15 to 18%. Meanwhile, their growth AUM is already up 26% year on year at 44,038 crore, and gross bad loans are just 1.2%, which is very healthy. The IHC deal in the background could also unlock cheaper funding, and for a lending business, cheaper funding is everything. If the model works, return on equity improves meaningfully. That's the bet FIIs are making. The honest risk here, though, is transition risk. This kind of shift takes real execution. You need RBI approvals, co-lending volumes need to actually scale, and funding costs need to actually come down. The next 2 to 4 quarters will tell you a lot about whether this thesis is playing out or not. Alright, now let's look at what DIIs are buying. And these two groups often think very differently. FIIs this quarter were largely buying transformation stories, businesses in the middle of change with re-rating potential. You'll see that DII picks have a slightly different flavor. Let's get into it. Let's start with DII stock number 5, Urban Company. With a market cap of roughly 20,843 crore, Urban Company at its core is trying to organize India's massive unorganized home services market. Plumbers, electricians, beauty professionals, AC repair, home cleaning, all of that currently happens through random local referrals and word of mouth. Urban Company is building a platform that makes it organized, reliable, and repeatable. And the reason DIIs are buying is that the business is starting to show really promising unit economics. Revenue grew 42% year on year to 383 crore last quarter. EBITDA margins expanded from 4.4% to 5.6%. But the number I found most interesting is that in their mature service categories, the ones they have been running for the longest, margins are already at 8%. That tells you that the model gets significantly more profitable as it scales and matures. DIIs bought roughly 837 crore worth of shares in March 2026 alone. There's also some exciting diversification happening. Their water purifier business called Native grew 93%. Their UAE and Singapore operations grew 79%. And even their loss-making InstaHealth segment cut its loss per order almost in half in just one quarter, which suggests the team is learning fast. There are risks though. InstaHealth remains expensive to scale. If customer discounts stay elevated or competition intensifies, the path to profitability could stretch beyond management's FY28 target. Okay, now let's move on to DIS stock number 4, Sedemac Mechatronics. Now this is a small cap name that most of you must have never come across. But when you understand what they do, the institutional interest makes a lot of sense. Sedemac makes electronic control units, basically the intelligent brain that controls how a vehicle or machine operates for two-wheelers, three-wheelers, gensets and EVs. In a world where every vehicle is becoming more electronic and more efficient, being the company that makes that intelligent layer is a very powerful position to be in. And here's what really separates them. They are not competing on low-cost manufacturing, they own the technology. The company holds about 30% market share in India's two- and three-wheeler specialized engine control unit segment, and globally they have about 14% market share in genset supervisory controllers and EFI systems. DIIs bought nearly 914 crore worth of shares in March 2026 for a small cap company that is a genuinely large institutional bet. What they might be seeing? That it could become a rare Indian auto tech company with its own products, strong pricing power and long growth ahead in EVs, power tools and exports. The risk to watch here is supplier concentration. Over 63% of their raw materials come from just 10 suppliers. That's a vulnerability. And if a new product fails to gain traction with a major manufacturer, growth can slow quickly. Now with that, let's move on to DIS stock number 3, Max Healthcare. India's largest listed hospital company by market cap at roughly 92,600 crore. Max has over 5,200 beds across Delhi, NCR, Mumbai, Mohali, Lucknow and Nagpur. And critically, 73% of those beds are in metros, exactly where the demand-supply gap is most pronounced. The numbers are solid. Revenue grew 9% year-on-year, profits grew 9%, and this was happening even while the company was absorbing higher staffing costs from new hospitals coming online. Return on capital employed is nearly 26%, which is genuinely impressive for a business that requires this much physical infrastructure. DIS bought 1.37 crore shares worth about 1,407 crore in March 2026. What they are buying into is a hospital platform that combines premium pricing power, high returns on capital, strong free cash flow, and a visible expansion pipeline that can keep earnings growing for several years. The risk is concentration. Max is still quite dependent on Delhi NCR and Mumbai, and competition from Apollo, Fortis and Global Health is real and intensifying. Now let's move on to DIS stock number 2, Lodha Developers. Market cap around 81,986 crore. Now there are two things working in Lodha's favor. First, home buyers are shifting from small builders to trusted brands, and second is the demand for premium housing in Mumbai, Pune and Bangalore is genuinely strong and growing. Lodha is capturing both of these shifts simultaneously. In the last 9 months, pre-sales grew 25% to 56.2 billion. Revenue grew 25%, adjusted profit grew 31%, and they added 588 billion worth of new projects, which is more than 2.3 times of their own full year target. All of this without stretching the balance sheet, which is the part that really matters. But here's the angle that's actually exciting institutions. Lodha is no longer purely a residential sales company. They are building steady income from commercial properties and also expanding into data centers. So over time, their revenue is becoming more stable and diversified. DI ownership moved from 3.17% in December 25 to 4.62% by March 2026. It sounds small, but for a company of this size, a 145 basis point increase in 2 quarters is a very meaningful institutional statement. There are risks though. Lodha is now expanding across cities simultaneously, entering NCR for the first time and pursuing data centers on top of all of that. If launches slow, if approvals drag, or if housing demand softens in Mumbai, the growth assumptions start looking stretched. Now let's move on to the most interesting company in this list, as it is the most bought company by DIIs, even with many uncertainties going on right now. DII stock number 1, HDFC Bank. HDFC is India's largest private sector bank at around 12.2 lakh crore market cap. But for the past 2 years, the bank has been stuck in a difficult post-merger integration phase after merging with HDFC Limited. Deposit growth was sluggish, margins were under pressure, the loan-to-deposit ratio was too high. And now, finally, things are starting to stabilize. Deposits grew 12.2% year-on-year to 28.6 lakh crore. Advances grew 9.8% to 29.5 lakh crore. Gross bad loans stayed at just 1.24%. Return on assets held steady at 1.9%. DII ownership went from 37% in December 25 to 40.1% by March 2026. They are essentially saying the difficult part of the merger is behind us and the benefits are now beginning to show up. The big unlock everyone is watching is the net interest margin. It's currently at 3.35%, which is still below where the bank has historically operated. As the deposits base strengthens and the bank gradually replaces expensive funding with cheaper deposits, that margin has room to recover, and when it does, the earnings impact is significant. Alright, so let's just quickly wrap